So today we're going to spend a little time talking about sources and uses of cash, what this really means in the context of a business, your business, or a business that you're considering investing in, um, what it means for you, what it means for the business, what to look for, what to try to avoid, any telltale signs of trouble or trouble on the horizon. So without any further ado, what is the cash flow statement? Cash flow statement reports the changes in cash versus its static counterparts. So the static counterparts being the income statement, balance sheet, and shareholders' equity statement. So the cash flow statement is more of a dynamic tool. It's actually gonna paint a lot truer picture, and it basically shows where cash is used and generated over a specific time period or the reporting period, and then it helps to tie the static pieces together. So, you know, every financial statement has its unique purpose. I mean, whether it's the income statement, the balance sheet, shareholders' equity statement, but then the cash flow statement comes in to try to tie these pieces together. Um, and you'll learn as you look at public companies, especially. Um, you can do a lot of creative accounting. Um, a bad quarter or a bad month can't turn into a good quarter or a good month, but you can move a lot of numbers around, move money around, and really make the statements say what you want them to say. But a cash flow statement really gives a lot more true representation of what's going on in a business. So a cash flow statement is really comprised of four different sections. So there are the operating activities. So this is cash that comes from operations. So selling a product or service. Um, the second part is investing activities. So if you've uh, invested into another company, um, or just any type of investment. Three is financing activities, and then four is supplemental information. So we're going to look at a couple of examples of cash flow statements here in just a second, just to kind of get a better idea of what this actually means. But just keep in mind you're looking for four pieces of information: operating, investing, financing, and then the supplemental information. So in this example cash flow statement, um, it is important to note that these are dollars, and then this is the fiscal year, the end fiscal year. So the report that would be generated at the end of the year for any key shareholders or the business owner. So cash flow from operations. You see the top heading. Net earnings were $2 million. And then we have additions to cash. So depreciation was added in, decrease in accounts receivable. So that means that the accounts receivable account at the end of the year was $15,000 less than it was at the beginning of the year. Increase in accounts payable, it's $15,000, same thing. So it's going to be, $15,000 increase in accounts payable. Increases in taxes payable is $2,000. And then they put in the subtractions from cash. So the increase in inventory is $30,000. So that means that their inventory level at the end of the year is $30,000 more than it was at the beginning of the year. So when you add all of those together, so you start with $2 million, you add $42,000 to it, and then subtract $30,000, you end up with $2,012,000. Okay. Cash flow from investing. So equipment, that's vague. Again, this is an example. If I was a shareholder, I would want to, I would dive into the other three financial statements and learn more about this equipment. But cash flows from investing, $500,000. That's $500,000 in the red. So that could be they capitalized some equipment that they purchased for the business. That was $500,000. And then cash flow from financing. Notes payable for $10,000. So, who are these notes to? What is their credit worthiness? And who signed off on that decision, right? So, cash flow for fiscal year ended on the 31st of December 2003. It was $1,522,000. So, what does that mean to you? Well, you earned $2 million. The big red flag for me, or the thing that I would be most interested in learning more about, was the equipment purchase. Does it help increase efficiency? Does it help to increase production? I mean, did we need to produce or increase production? Did we have orders that we couldn't meet demand for? So, like the actual thought process of why do we need to spend a quarter of our net earnings for a year in reinvesting into our business? Okay, so that would be my personal question if I was thinking about investing in this business, or if I owned a stake in this business. So here is another statement of cash flows. Again, this is the 7th month. So this is July 31st. So operating activities, net income 100, add back depreciation expense 20, loss on sale of equipment. Interesting. So they sold some equipment and they took a loss and they added that back in. Their inventory went up by a lot in this period. Their supplies went up by a lot. So at the end of the day, so the cash used in operating activities was 50. I'm assuming that this is 1,000, but we don't see that. But purchase of office equipment was 1,100, and they sold office equipment. So there you can see that they bought new office equipment, sold old office equipment, and the net change was $200 red. So $200 down. And then I would imagine that the owner invested $2,000 to offset some of the use of cash during this period, to give the net increase in cash a positive $1,750. So this tells you a lot more than the other three financial statements will tell you. I mean, this really dives into what happened. I mean, you see that you see where cash was used during this period, and it helps you a lot. I mean, it really does. It actually looks like they. This is definitely a startup, because you can see that the cash at the beginning of the year was zero. So interesting. So that's probably why they were investing so heavily in inventory, supplies, and then office equipment. Interestingly enough, they needed to sell office equipment, but I'll leave that one alone. So as you look at a cash flow statement, just a few things to remember. There can be big differences in the income statement and cash flows, because the way that the transaction is recorded and when the money received can vary between these statements. Or management can be using an aggressive revenue recognition system, or it could be asset intensive. But the key to remember is that the cash flow statement is often the most transparent of all financial statements. So when you're looking at a business, whether to invest in or your own business, the cash flow statement doesn't lie. So with that being said, I welcome any comments, feedback, or suggestions, and thank you so much for watching.